And just do a thumbs up. Yes to both. Cool. In the chat. That's great. Thank you. All right. So welcome everyone to the FINM7322 Test 1 Masterclass or Financial Management 3B Masterclass. My name is Claudia DeRocha and I will be taking the session today.
Girl, I cannot hear you.
I'm just going to put people on mute quickly. Just let me do that. Okay. All right. So we should all be on mute now. Okay, so just in terms of myself, I have done the Financial Management 3A masterclasses as well. So I'm doing the Financial Management 3B masterclasses as well this semester. And as I said, my name is Claudia. I do lecture at one of the brands or one of the campuses. All right. So overview for today's class. Test 1 is all about Learning Unit 1 and Learning Unit 2. Your test 1 will be 50 marks, 60 minutes, so an hour. And to break up the two sections, we have Learning Unit 1, which is cost of debt, preference shares, and equity. So in essence, the cost of capital. We then have weighted average cost of capital. So this is a link to what you would have done in Financial Management 3A. And then we have weighted marginal cost of capital, which is new to this module, and then investment opportunities schedule, which we'll chat about. Then in Learning Unit 2, we have operating break-even point. We then have operating financial and total leverage and earnings per share and linkage. So earnings per share is something that you would have been doing in financial management since 2A, and it does repeat. So we do start looking at earnings per share in a different way in this learning unit. All right. So to start, as I've done in previous sessions, all the formulas. So again, there are quite a few formulas. And with the formulas, not all of them again will be included in your formula sheet. I will again share that formula sheet with you, an example, so you can see what's on there, but not all of them are included. So again, you do need to learn the formulas. In terms of this formula, I do need to just make an update. So in terms of the formulas, we are looking at cost of debt first. Then we're going to look at cost of your preference shares and then cost of equity. So there's three types of financing that we're looking at, and there's different formulas. Cost of irredeemable debt. So we have certain types of debt. First one is the irredeemable debt. Irredeemable debt meaning there's no set maturity date, so you can redeem it or pay it at any time. The standard formula is I over PO. And then we have the formula below is for compounding. So there is an M missing under the I, and this should be N divided N times M, which I will just update when we go to the mural. So you do need to know these formulas. The first one's obviously there's no compounding. Second one, if there is compounding. So it's quite important to identify that, but we'll unpack that a bit more in the mural. Then we have your cost of redeemable debt. So your cost of redeemable debt or your redeemable debt itself is debt where you have a fixed maturity date. So you know in a certain amount of time that you will redeem the debt. There are no formulas here. Well, there is a formula. It's actually the one that we just showed you, but what it requires is interpolation. So For me, I say there's no formula. We use financial calculators, and the whole point is to calculate IRR, so internal rate of return, which we would have done in Financial Management 3A. So I will unpack that with you as well today. Then we have cost of floating or variable rate debt. So this is when debt is pegged against a variable rate, normally prime. And so the interest does fluctuate. So the formula there is R is equal to RD times 1 minus T, where T is tax. So we're basically looking at the pre-tax cost of debt and then removing tax off it. And the pre-tax cost of debt needs to be an equivalent fixed rate debt. So in other words, we find a debt that's equivalent to this debt, but with a fixed rate, and then we use that rate, not the variable rate. Then we have cost of corporate debt, or in other words, bonds. Bonds would have been covered in Financial Management 3A. So this is a follow-on from that learning unit that was covered in that previous module, or in the 3A module. So the same principles apply. You need to understand what face value is, what par value is, what a coupon rate is, etc., so that you can apply it. And the only difference between what you would have learned before and now is that your coupon payments are after tax. So again, we don't use formulas. We use the financial calculators to calculate the IRR, internal rate of return, which represents the cost of the bond or the cost of debt. Right, now we're moving on to preference shares. So as I said at the beginning of the session, we're looking at the moment at cost of capital, 3 types: debt, preference shares, and equity. We've looked at the debt ones. We're now going to look at preference shares. So with preference shares, the main formula is RP is equal to DP over NP, where NP is your net proceeds on sale of a preference share and your DP is your expected annual preference dividend. So this is the formula that is used for all types of preference shares with some differences. There's a formula that's completely different. So you need to know that. And then there's just a different application for one of the preference shares, which I will explain as well. So the type of preference share where the formula is very different to the base formula is the cost of redeemable preference shares. And when we mean redeemable preference shares, it means that we have to pay back or pay the dividends in a certain period of time. They're only valid for a certain period of time. And so there's a very specific formula that we use. So we have KP is equal to AD plus RV minus SV, all over NR, and then all over RV plus SV to the power, divided by 2. So what does that mean? AD is the annual dividend, RV is the redeemable value, SV is the sales value, NR is the number of years for redemption. So this is very specific. And like I said, again, it's only the one formula that is different to the other preference shares. Then we have cost of convertible preference shares. So when we talk about convertible preference shares, we're talking about shares that convert into another instrument. So the formula is the same. There is no difference. It's just in terms of the way you would calculate your preference shares, because you would need to take into account if they're converting, what their value would be if they were to convert. Then we have the cost of participating preference shares. So participating preference shares is where you now have voting rights, and the formula again is the same, has not changed. Then you have cost of cumulative preference shares. So cumulative preference shares is where the dividends that is meant to be paid every year is accumulated. So if it's not paid in 1 year, it's held until the next year and then paid. So the formula is the same as per other preference share formulas. The only difference is your dividend would be the accumulated dividend that has not been paid. So for example, if in the previous year there was a dividend and that wasn't paid, this year you will then say the dividends is last year and this year's dividend. And then we have cost of callable preference shares. So callable preference shares means that you can ask for them to be paid at any time. And again, the formula is the same, no change there. Okay, so before I move on to the cost of equity, just want to double check if there are any questions.
Blechman.
Okay, so there's just been a question on the chat. I'm just going to answer that quickly. Okay, so the question says, where does the convertible bond fit in all these costs that you just went through, ma'am? So the convertible bonds is basically with the corporate bonds. So your bonds is the convertible or the corporate debt. So if I share my screen again. Okay, so if I go back, it's part of the corporate debt part. This corporate debt. So any bonds, convertible bonds, normal bonds will fall under your corporate debt, and you use your financial calculator to calculate that. Hope that's answered the question. Okay, so next part is the cost of equity. So we have two main types of equity that we deal with. We deal with retained earnings, and we deal with new issue of shares. When we are dealing with cost of retained earnings, there are basically two formulas that we can use. It's either the dividend growth module formula that's been manipulated to solve for RE, or it is the CAPM formula that you would have learned in 3A. So it's one or the other. And it all depends on the question and what's being asked. That's very important. So here you have the first one, that is the dividend growth model formula. So it's the cost of retained earnings, and you get your expected dividend to be received in the next period over the value of the share today plus your growth rate. And then remember, if you can, from 3A, there is a growth rate formula that we must know. So that formula we must know, and I'll revise that again when I go onto Mural and show that. So I will bring that up and just show everyone that. And then our CAPM formula hasn't changed. It's R is equal to RF plus B times RM minus RF, where RF is the risk-free rate, RM is the expected return of the market, and B is beta. And remember, your beta is always 1. So they can also ask you or say to you that the beta of the company is in relation to a certain way. Hey, then with your cost of issue of new shares, most of the time, I mean, CAPM can be used, but most of the time it is the formula D1 over NE plus G, where NE is your net proceeds from the issue of new shares. And the net proceeds does have a specific formula, which is your gross proceeds less your flotation costs, but I will note that in the mural as well so that you can see on the electronic e-whiteboard. Again, growth rates included. Again, it's the same formula that we would have used in 3A to calculate the growth rate. So we need to use that as well. Right, then in Learning Unit 1, we also have the WACC. WACC is the same formula that you would have learned in 3A. The only difference now is that we're adding your preference shares. So you see here where there's a P, we are now adding the cost of preference shares. So we just went through cost of debt, cost of preference shares, and cost of equity. And here is the formula where we calculate the WACC, including all those costs of capital. So first part is for debt, weighted debt times your return on debt times 1 minus T. And then the second one is for your preference shares or weighting of preference shares times return on your preference shares. And then the third one is weighting on equity times your return on equity. So like I said, this formula has not changed from when you learned it in 3A. The only thing that's happened is that they've added preference shares with the same principle of weighting times your return. What is also additionally different in 3B now is that you have different types of weightings. You have three types of weighting, either book value, you either have it on market value, or you have on target weightings. So it means that now in your question, there can be different types of weightings. Either it's given to you, you've got to calculate it, and you've got to incorporate it when calculating the WACC. Right, then we have the weighted marginal cost of capital. So the weighted marginal cost of capital is basically where we're looking at what we call breakpoints. So breakpoints is where what happens to our cost of capital if certain additional funding is made available. So we're looking at funding and we're looking at what happens when that is made available to our cost of capital. So this section of the learning unit has to do with calculating a breakpoint. So breakpoint is where we have a shift and then plotting it on graphs. We've got a weighted marginal cost of capital graph, and we have also the investment schedule graph, which I'll show you, or I'll go through that just now. And yes, we do need to know how to interpret the graphs and to draw the graphs. Must know how to do that. So what I will do is I will just run through those two graphs and what happens when you plot them together so that you know them and understand them. And again, you must know how to interpret and draw them, and obviously based on or when you're drawing them, based on your calculations that you've done. So with the breakpoint, it's CFA for WCS, CFA meaning component funds available, and WCS meaning weight in capital structure. Okay. And when we're talking about weight in capital structure, we're talking about the weighting. So either the target weight, the book value weight, or the market value weight, and the component funds available is about when how much are the funds that are available for a certain type of capital. So in the question as well, you know which type of capital needs to follow a breakpoint calculation when they say the funds are limited. So either they're going to say funds are limited, or either they're going to say that there's only a specific amount for this type of funding. So it's very important to be able to identify that. Okay, so before I move on to learning unit 2, I just want to double check that there are no questions. I just want to make sure I write or respond to this question. Okay, so Luke is asking me when this will be uploaded. So in essence, once we're done with this session, I will then share it with the contact at the IE, who will then upload it. So I'm hoping for tomorrow the latest. Yeah, that's when it should be up. Okay, let's move on to learning unit 2. Okay, so with learning unit 2, there's not as many formulas as in learning unit 1, but there are key things that we need to know. So the first thing that we must know is the operating break-even point. So when we're talking about the operating break-even point, we are looking at leverage here. What we mean by leverage is how we utilize the operations, or how we use our financing to create more profit for us. Okay, so we look at earnings per share, we look at EBIT. So with your operating break-even point is at the point at which you start making profits. And the formula for that is OBEP is equal to your total fixed cost over your contribution per unit. So there isn't anything different to the break-even point formula you would have learned in Financial Management 2A. So in Financial Management 2A, quite some time ago, you would have learned the break-even point formula, and it's not anything different to what's being used in leverage. The only thing is that we're looking at the operations. So we will be looking at specific operational amounts, but the formula is the same: total fixed cost over contribution per unit. Then we have the degree of operating leverage. Okay, so here we are looking at how, I suppose, how impactful is or how affected is our EBIT to changes in operations. Okay, so that's what we're looking at. And there are two formulas. There's the percentage change in EBIT divided by the percentage change in sales, or you can say contribution divided by EBIT times 100. Okay, both of them will give you that. And when we're looking at EBIT, it's earnings before interest and tax. We then have the degree of financial leverage. So the degree of financial leverage is the change in EPS divided by the change in EBIT. And you've got a second formula, which is your EBIT divided by your EBIT less interest, less your preference dividends after tax times 100, because we want to get the percentage. So in essence, what we're looking at is we're looking at in the second formula, what is our EBIT versus the EBIT excluding all dividends that are or payments relating to financing, and it is a percentage. Okay, then we have earnings per share. So earnings per share is not a is not an old formula. It's not a new formula. I mean, it's an old formula. It's nothing new, or at least understanding. I know previously, like in 2A, we would have learned earnings divided by a number of shares give you earnings per share. That would have been the formula. But here in 3B, we look at basically taking your EBIT less your interest, less your preference dividends after tax divided by the number of periods, the number of ordinary shares in issue. So in essence, it's not anything different to what you've learned before, because it's still your earnings divided by your number of shares. It's the same. Just in the textbook, they've done a different formula. So I will then on the whiteboard show you how it links to what you would have known before. Okay, so it's just the way that they've structured it. There's nothing different there. Okay, the one thing I don't see here that I actually need to put is the degree of total leverage. So your degree of total leverage is the change in EPS plus your change in sales. So I'll just make sure that I also put that up for us, because we must make sure we know that. All right, then we have linkage. Okay, so linkage is the last part of this learning unit. There are also some graphs in this learning unit that we must also at least know. The one we must know, which I will just run through a little bit quickly once we've done all the mural stuff. Yeah, so there is definitely a graph, and again, you've got to know how to draw it. You've got to know how to interpret it. Um, for test one. All right. So with linkage, okay, what we are looking at is the impact and the change in financial risk. That is what we're doing. So we're looking at our earnings per share in relation to our return on equity. So earnings per share divided by return on equity. And that will then give us our price per share. And based on our price per share, obviously, the higher the price per share, the less impacted is by financial risk, and vice versa. All right, before we go any further, are there any questions? All right, so I see there are no questions. So I'm going to take us now to the mural. Okay, so I'm going to just share my screen now. Okay, so please just confirm that you can see the screen just with a thumbs up. Okay, I'm assuming. Okay, so I'm assuming everyone can see my screen. I'm just going to go back. I do see there's a question on the intersection of the graphs. Yes, I will run through, very briefly the graph on the iOS and weighted marginal cost of capital. We'll do that. Just typing it here. Yeah, so we'll go through it. It's really not too difficult, but I will run through that, no problem. Okay, so as we did say, learning unit 1 formulas. Basically, we have, in terms of your irredeemable debt, there are 2 formulas. It's quite messy now. Right, so the first one is RD is equal to I over PO, I being the interest payment amount. So what's critical is that it is an interest payment amount. Get some nice colors. So it has to be interest payment amount. Right, and then the PO is your current X interest market price. So that's very important that we understand that. So I'm just going to write that so you can see what I mean. All right, so like I said, what's kind of important is the X interest market price. So you must make sure that whatever market price they give you, it is excluding interest. Okay, so then it must state that. Okay, then we've got our second formula. So this second one, we use it when there is compounding. So I'm just going to note that. All right, so to run through the formula, we basically have I plus I over M. So I know it does look quite messy, but this is one part Okay, and then you've got the PO, and then you've got the N times M, which should actually be quite small, but or superscripted. All right, so let me just quickly highlight that for you, or at least put in all the different pieces. Okay, so if I draw here, this is your interest. Let me do this rather. This is the same as this one. Okay, M is for compounding. Okay, PO is the same as your current X market price. So that's the same. And then N is your number of periods. Okay. Cool. Everyone comfortable there? Okay, so let's move on to the cost of redeemable debt. So like I said, there's a user financial calculator. So in essence, what's going to happen is in your present year or CF0, cash flow zero, you're going to put the current value of your debt. Okay, so current value of debt. Then for each year, up until the maturity year, so between year zero and the maturity year. So let's say, for example, that this debt redeems in 10 years' time. So from year 1 to year 9, you're going to include your coupon payments or interest payments if it's not a bond. So I must just use my words correctly. So here it will be your interest payments. And it must be after tax. Very important. And then in CFN, that would be your last year. So whichever year you are redeeming. And that is how much you are going to pay for the bond. So it's normally your face value of the bond or par value of the debt, not the bond, of the debt. So value of debt plus the interest for your nth year. Yeah. And then you compute for IRR. So it would be the same way you would have done it in 3A. Same way you would use your calculator. Okay, then again, your cost of floating or variable rate debt. It's basically your debt before tax. Just want to update this to a 1. That's what it should be. Right, then with corporate debt, it's exactly the same as what we've done here. Just copy that over where we are. Okay, so the current value of your debt, this will be your coupon payments now. And then the CFN would be the same. So whenever you use a calculator, your CFO zero is your current value of debt. You then from year 1 to the year before the last year, it's your interest amount or your coupon payments after tax. And then the last one will be your value of debt plus your interest or coupon payment in this case after tax. Right, then we have our cost of irredeemable preference shares. So this is your dividend. Okay, and NP is your net proceeds. Okay, when we're looking at net proceeds, It is your gross proceeds. It is your flotation costs. Okay, and when we talk about gross proceeds, we are talking about the price of what you'll get for the shares now. Okay, normally it's the price what you get the shares now. All right. Then we go to our very long formula for redeemable preference shares. Remember I said all the other preference share formulas are as per this one. Okay, they don't change. But for your redeemable preference shares, it does have quite a difference. Okay, so when we look at AD, then your SV being your sales value. Your NR being the number of years for redemption. Okay. Then, like I said, for your convertible preference shares, your participating preference shares, and the rest of your preference shares, the formula is exactly the same as what we did here for cost of redeemable preference shares. It's the same. So if I just do maybe a little arrow guy to help us. Same. All right. Then we have the cost of retained earnings. So the cost of retained earnings, remember I said it's either the dividend growth model or it is the CAPM. The first one is the dividend growth model. Okay, and then in terms of our little elements on here, D is your D. Then we have our PO. And then we have our growth percentage or expected growth rate. And then remember with our expected growth rate, we have a particular formula that we would have learned in 3A with the growth rate. So I'm just going to show that. Give me a second. Okay, so on the growth rate, the formula is, and I'm just going to actually write it here for us so that we have it. Okay, so this is the formula that I would have run through with you in the masterclass. It would have been the exam one for 3A. So its growth is equal to dn over do to the power of 1 divided by n minus 1. So dn being the dividend at the end of the period and do being the dividend right now. Okay, so it's important that we still know this formula. Then we have our CAPM formula, which we should all know. Okay, this is the risk-free rate. Okay, same as this one. Okay, and this is our expected return in the market, the market return. And then you have your B. Choose a different color. All right. Then we have the formula for when you have a cost of issue of new shares. Okay, so the only difference between this formula and this one, so the two that are, is that we are doing NE, which is your net proceeds. Okay, that's the only difference. You have your net proceeds, which we've done already. Okay, and this is your growth as you would have done here. Your net proceeds would be the same as what we did here. So if I just go further up. Okay, well, let me just write that out again, just easier. Yes, your gross proceeds less your flotation costs. And again, your gross proceeds is the price of your share today, basically. Right, then we have the WACC formula. So we should know all of these component parts because it's not anything new or different. Okay, so weighting of debt, weighting of your return on debt. And then the last one for learning unit 1 is your breakpoint. And then you'll divide it by your weight in capital structure. Okay, any questions there before I move on to the learning unit 2 formulas? Okay, so I see this is a question about the RD compounding. So the irredeemable debt compounding formula is not in the textbook officially. It is in one of the questions of the textbook, and then they've got the formula, but it's not officially in the textbook. Cool. Perfect. All right, so I'm just going to pause there for a minute or two. I just need to quickly make sure that the power is working on my laptop. So I'm just going to pause it for a minute or two, and then we'll restart with the formulas. And then once we're done, we'll restart with the learning unit 2 formulas as on the whiteboard. And then from there, I'll do, we'll go into past paper, or I'll go through the graph, the WMCC graph and investment schedule graph. And then what I'll do is I'll then go to past papers. All right, so just give me a minute. All right, so let's continue. All right, so with the learning unit 2 form is not many, as I did say at the beginning. So first one is the operating break even. That's your total fixed costs. Over your contribution per unit. And as I've said, this is not a new formula. Okay. Right, then with our degree of operating leverage, it's this percentage change. So I've just put a C here of your EBIT, of your percentage change of your sales. So this item here is your EBIT. Or your earnings before interest and tax. And then here with your degree of operating leverage percentage contribution divided by your EBIT times 100. Then with the degree of financial leverage, we have your change in EPS, so your earnings per share. Divided by your change in EBIT. And then here you've got your EBIT, or the other formula, which is EBIT divided by EBIT minus I being your interest. Your PD being your preference dividend. And then T being your tax. Right, and as I said, there's also the total leverage, which is, in essence, the combination of the two. All right, then we have the earnings per share. So like I said, this is the one in your textbook, but there is another formula that we all know that we would have known from 2A. Okay, so that other formula is our earnings divided by your number of shares. Okay, so it's the same as that. Nothing's really changed. They've just shown it in a different way. And then the last one is for linkage, where we calculate the price per share. So we have our earnings per share. or divide by the required return or the return on equity. Right. And those are all the formulas. Any questions before I move on to the graphs that we need to just go through and some past paper questions? Okay, so the question is, how do we know when to use the base level or the percentage form? Is really dependent on what's given to you in the question. Most times you can do the base level because the RAND value is being given. The percentage is you got to calculate the percentage movement. So it really depends on the question. Yeah. Yeah, hope that answers your question. Okay, so let's go to the graphs now. So it's particularly in Learning Unit 1. There's also graphs in Learning Unit 2 that you do need to know, or just one really, that you need to know that combines all the graphs. But I will go through that. Okay, so the first one that we're going to look at is the weighted marginal cost of capital and the investment schedule, the IOS, investment opportunity schedule. So I'm just going to bring up a blank Excel sheet that we can follow. Yes, let me share that blank Excel screen. Okay, so in terms of the two graphs that we have, just trying to see. Okay, right, let me reshare. All right, so in terms of the first in Learning Unit 1, so let me actually put a heading in terms of the graph. So Learning Unit 1. And let's just make this bigger so you can see. Okay, so you're learning Unit 1 graphs. Okay, so we have two graphs that we need to worry about. The one is the weighted marginal cost of capital graph. Okay. That's what we are worried about. And in essence, what does it show us? It shows us our WACC percentage versus our new financing. So how much are we getting for financing? Okay. So in essence, when we are drawing this particular graph, you have to do the breakpoint first. Okay. So I'm just going to put under here. Okay, so calculate breakpoint. Your breakpoint is the formula that I would have shown you. So if I actually, let me maybe share my screen a different way, then you can see the two together, and then I can show you what I'm talking about. All right, so if I have to show you my full screen, okay. Right, so remember this formula where we did the breakpoint? Let's see if I make that a bit bigger. Okay, so the breakpoint. So when we are dealing with this weighted average cost of capital, first thing we have to do is calculate the breakpoint. That would then tell us the range with which we are working with. Okay, so let's assume the range is, I'm going to say assume, or let's assume breakpoint is, okay, let's assume we've done the calculation. We assume that breakpoint is 100,000 Rand. And remember, we do the breakpoint for each type of financing where the funds are limited. Okay, so in a question, you'll have lots of information. They will say to you that things are unlimited, unlimited, and then all of a sudden you have a cost of capital where the amount is given or they're telling you it's limited. So that is when you do breakpoint. So assume we calculate the breakpoint. We've taken the available funds, we've divided by the weighting, we get 100,000. Okay, what it means is we have ranges. So second step, is to determine the range. Okay, that's what we need to do. And what is the range? We start from 0 to breakpoint, and then breakpoint to beyond. Okay, 0 to breakpoint, and then breakpoint to beyond. That's what we do. So in our example, we would say that it's 0 Rand to 100,000. And then your breakpoint, and then breakpoint to beyond, we say it's 100,000 to whatever it is, or we just say beyond or from 100,000. Yeah. Okay. Okay, that's determined the range. Then the third step is that we would have had to calculate Okay, so you would have to calculate your cost of capital. So if you have debt, you have to do cost of debt. You'd have to do cost of equity or preference dividends or preference shares, preference shares, cost of equity. Okay, so we do all of that. Right, so we calculate cost of debt, cost of preference shares, cost of equity. And then what we do is, fourth step, is we do the weighted average, the WACC. Okay, sometimes in your question, they might have asked you this part first. So they might say, calculate the cost of capital, and you've got to calculate for each item. And then you would go first step, calculate break rates, determine the range, etc. Okay, but if you had to do it from scratch, we first get the break point, we determine the range, we then calculate cost of capital, then we do the WACC for each range. Okay, so it depends. Okay, and when we say WACC for each range, we're saying 0 to break point and then break point to beyond. That's what we're saying. Okay. Right, so let's imagine that we've calculated the WACC for each of these ranges to be, let's say, 10% and then 15%. Okay, so in terms of our graph, if we have to plot, okay, we would then obviously note here what are the different ranges. So we would say 50, okay, so I'm going to say 50, 100,000, because that's just in terms of the range. And then here I'm going to break it up into maybe 5, 10, 15, 20. Let's say we've done it like that. Or maybe even I'll do it a bit higher so it's not so squashed. Okay. So how do I plot the graph? So what I'm going to say is when the break point is, or the range is from 0 to 100,000, it means at this point where I have 100,000 and my WACC is 10, I'm going to draw a line. So here is my little, let's say this is my point. Okay. Purple color so you can see nicely. Okay, so you're going to go all the way to where we have the 100,000. Okay, then we go to the next range, which is from 100,000 and beyond. So what we do is we come up here to where, because we assume the percent is 15, and we draw another line from the 15 where the 100,000 is to the end. And then what we do is we connect these two. And that is our weighted marginal cost of capital graph. Okay. Right. That's the one graph. The other graph we have is our investment opportunity schedule. Okay. So our investment opportunity schedule, what's the different is that we are dealing with the internal rate of return. Okay. So if I have to just copy out this and bring it next to it, and I'm just going to extend this so you can see. Let me just change the sharing screen so you can see only the Excel sheet. Okay, we are going to do the IOS graph, or the investment opportunity schedule. Okay, so with that, we're now dealing with the IRR percentage and your total new investment. Okay, with this one, yes, we would have already calculated the break point, we would have already determined the rate, we already calculated cost of capital. But then, oh, we actually don't need this one, cost of capital. What we would then do, we have the breakpoint, we have the range. We then have, let's just get this out. Okay, we're going to create what we call an investment. Okay, so what is that? Basically, what we do is we'll get a list of internal rate of returns for different funds. And we would need to basically place them ranked. Okay, so I'm going to say rank from highest. Okay, so you rank from highest RR to lowest. And then what you do is you actually then also accumulate the funds. So if I had to create one, as if I had to actually create one, so let's say we have projects, we have, we have our funds required. We have our cumulative funds. Yeah, and let's assume I'm just going to make up some, different percentages. Let's say it's 25, 15, 10, 5, and let's say 2, or let's say 3. And let's say the funds is 300,000. Okay, so I'm just doing it like that. And then what we do is we just add up the funds. So this is a table that you would create because this information, the IRR percentage and the funds required would have been given to you. So you have to create this table. Okay. All right. That's where we are. Okay. Now I'm going to try draw the graph. So like I said, we have to make sure we have the right denominations here. So I'm just going to work in 300,000. And remember, you can choose whatever denomination you want here at the bottom. It's your choice. 391, 200, 500. Okay, you choose what you want. Same with on the left-hand side for the RR percentage, you choose the denominations you want. I'm also just going to do 3%. Maybe I'll change it rather to 5, 10, 15, 20, 25, 30. All right. Then we're going to plot our graph, and this graph is going to go in the different direction to this one. Okay, so these two go in different directions. They don't go in the same direction. All right. So we look at the 25,000. So we know it's here, and we're going to 300,000. So we're going to take our and we obviously mark it where the 300 is. Okay. Then I'm going to go to the 15%, and I'm going to note where it says 600. So I'm saying it's somewhere between 300 and 600. And then what I'm going to do is connect these two. So it's a step graph. I'm then going to go to the next one, which is 10%. At the 900 mark. Sorry, don't do what I did. It needs to be at the cumulative number. So I must be using these values. Let me actually just highlight that. Those are the values I must use. Okay. So it needs to be at right. Then we have the next one, which is 10% at 1/100. Okay, so we know 1/100 is more or less in between here. So I'm going to okay, and then we have the last or the second last one, which is 5%, and it's at the 1,200 Rand mark. So it'll be quite close to this one. Yeah, and the last one being the 3% at the 1,500, which would be somewhere in between here. Okay, and that would be what your graph would look like. And then in essence, what we would need to do is merge these two together and see where the two intersect, and anything towards the left we would accept. All right, so I'm just going to stop there and see if there are any questions on that. Okay, so there's no questions. So obviously I haven't intersected the two graphs, but in a question you would need to intersect the two graphs, find where the point is. Anything to the left is what you accept or not accept. Okay. Then there is also another graph in Learning Unit 2, but I want us rather to move on to the one of the past paper questions. I had two and only one it looks like we'll have time for, but I'll still share the other past paper question with the solution. So I'm going to go into that past paper. It will be a Learning Unit 2 past paper question because we've done the Learning Unit 1 graphs. So we can go through that. I'm just going to bring that up in a sec, and then we can go through that. All right, so I'm going to bring up the question now, just share my screen. Right. So you should be able to see the past paper question and then my Excel sheet. So with this question, it is 30 marks. Therefore, minutes is 36 minutes. And we'll try and finish it before then because we've only got 20 minutes left of the session. That's the first step always. The second step is we go to the required. So here it's asking us what is leverage. So that's a theory-based question, which I'm not going to go through now. We should know how to answer that. So I won't go through it now. What's important is that we do the calculation. So it says calculate the break-even level of sales in units. Calculate the degree of operating leverage, calculate the degree of financial leverage, and calculate the degree of total leverage. And what's critical is that they're asking us for the monthly sales. Okay, they're not asking us for per annum sales. They're only asking us for the monthly ones. So that's what's really, really, really important. Otherwise, we are going to be calculating incorrect things in this question. All right, so let's go through the information and let's see how we would answer. So it says the CEO of Discam, Roy Murray, has come back to you for further assistance. He is considering a major expansion into the rest of Africa for Discam that will require a significant investment in new machines and equipment. He would like you to analyze the project's financial viability and determine the optimal capital structure for funding the expansion. And then we have additional information as at 28th of February 2025, or at the current financial year is 20th February 2025. And we have our project information. We have our EBIT and EPS and the corporate tax rate as well. So the project information, we have the demand with the total selling price, with the variable manufacturing overhead costs, direct material costs, direct labor cost, your commission costs, and your fixed costs. And then you have your EBIT, EPS, you have it for 2025, 2024, and then you have your EBIT and EPS values. Okay, so there was a question previously on the chat about whether I use my base level formula or if I use the original formula. So what is meant by that? When we've got our formulas in Learning Unit 2, this formula at the bottom is considered the base level, and this is the the original formula. So we use this when we don't have the change in EBIT or change in sales. Obviously, you can calculate it, but here we're going to most likely use, I mean, we'll obviously just look at when we calculate this baseline here. Okay, but before we go there, we have to calculate the break-even level of sales in units, which is this formula. Okay, the OBP EP is equal to TFC over CPU. Okay, so that's first things first. We need to obviously write down our formula. Okay, so OBP is equal to TFC over CPU. Okay, so what is very, very critical? The first thing is to get our fixed costs. All right. We're dealing with 2025. It's 600,000 per month. And we've got our per unit thing. So what's the trick here is that when we calculate our total fixed cost, it has to be for the year. Okay, so when we're doing our total fixed costs, we are going to say 600,000 times 12. Okay. So we must do that. Why? Because it's per month, and to do the break-even point, we want the full value. Then we're going to divide this by the contribution per unit. So how do we calculate the contribution per unit? Okay, we've got a total selling price. Okay. So we've got our total selling price per month is 23 million basically. And we've got demand of 23.5 per unit per month. So what's interesting here is that we have a per month amount and a unit amount. Because they haven't given us the per unit amount, we have to calculate it, right? Because remember, our contribution per unit is always per unit. So we have to say the 23 million divided by the the 235,000, the demand. Okay, so that's actually not rands, it's the demand. Okay. And then there we're going to minus all the variable costs. Remember, our contribution per unit is your selling price less all your variable costs. So all our variable costs, we've got the 20 rand plus the direct material one. Okay, so we've got the 20, the 25, we've got the 10. Also, commission needs to be added because that is a variable cost. Revision of financial management 2A. Okay, and then once we have that, we then calculate our answer. Okay, divided by the 40. Okay, and the answer we get is, okay, and remember it's 180,000, oh, the answer is in units. That's what we're calculating. It's in units. Right, that's the first one done. Okay, when you go to the next one, we're going to calculate the degree of operating leverage using the current monthly sales. Again, you've got two formulas, okay? So we can either use the percentage in EBIT, the change in percentage EBIT over the change in percentage sales, or we can use contribution divided by EBIT times 100. Okay, you can use either, it doesn't matter. But in this case, we are going to use what they call the baseline formula. Okay. So our baseline formula is DOL is equal to your contribution divided by your, make sure I see, your EBIT. Okay, so to remind you, this is the formula that we're doing. Okay. Okay, so what is our contribution, right? We're dealing with the 2012 financial year. So if I bring up the question, it's asking us for a contribution for the 2025 financial year. Okay, so we have to use what's here. So our unit sales is 2350. And our contribution, we know was 40 because we had our contribution here. So if I just had to make that into a different color so you can see. Right. Okay, so our contribution is, and it's not contribution per unit, so it's total contribution. We're going to say 20,500 units, okay, times 12 because they've asked us for the monthly times the 40 Rand. And then we're going to divide by the EBIT. Luckily for us, they've given us the EBIT. There really isn't anything that we have to calculate. So we just have to include the amount. Okay. So if we have to calculate that, we get 1128. Okay, which gives us what? Obviously, we have to times by 100, which I haven't been doing. So let me just make sure I include that as well. Okay, so if we do that, we get 247%. Okay, then we have question, so let me just change the numbering because remember 2.1 is a theory question. Okay, question 2.4 says cut the degree of financial leverage. Okay, again, we're going to use the baseline formula. So the degree of financial leverage percentage, actually, that's what I mustn't forget here. Okay, so if I go back to our screen, this is the formula in essence we can use, the one at the bottom. Okay, so it is equal to okay, so yeah, so this is where now the question gets a bit difficult because, like I said, we said we can use this baseline one, but can you see we need EBIT, we need interest, we need preference dividends, we need tax. We've got the tax amount, we don't have the preference dividend, we don't have the EBIT, we don't have the interest. So what does that mean for this question? It means that no, we can't use the baseline one. We have to use the original formula. So this is how, and I know there was a question before, how do you know which one to use? It's about understanding what we have. The formula that we're using is your percentage change in EPS divided by your percentage change in EBIT. Okay, luckily for us, we do have our EPS number, we do have our EBIT. Okay, so how do we calculate this? To do our percentage change, we have to deduct the two values from each other. Okay, so we've got the 9.14 and the 3.3. So what has changed, right? So we can say 9.14 less 3.3 for our change in EPS. Okay, and we divide this all by 3.3 because we want the percentage. So I am saying 2024's value less the 3.3 divided by the 3.3 because this is my base year. You can also say 3.3 minus 9.14 will just give you a negative number, which doesn't actually matter. Okay, and we're going to divide that all by now percentage change in EBIT. So our percentage change in EBIT was the 660 less the one in the previous year. Okay, all divide by your 2025 or 2025 number like we did before. So the 557. Okay. And that will then give us an answer of 1.77 divided by 0.106, which then gives us okay, so 1,669% is the answer. Right, now we've got the last one, is the degree or a degree of total leverage. Okay, so degree of total leverage. Okay, so with the degree of total leverage, the formula is the percentage change in EPS divided by your percentage change in sales. Okay. So your percentage change in EPS, how do we calculate that? Your percentage change was over here. It's the same one that we had here. So if I highlight that in a different color for you. Let me just track the colors because I didn't do that. Okay, so we had the 1.77. Hey guys, here I've made an error. It's actually our 0.44. Okay, it gives you 42%. Just fix that. Okay. Then here we've got a percentage change in EPS, which would be the number in purple, because that's exactly what we had before. Okay. Versus your percentage change in sales, we have to calculate that using the sales figures that we have. Okay. So we know that our sales is the basically we have the value which we should have calculated earlier. I think it was here where we did our times our selling price, which is 2,3,500, right? Let's see. It's our selling price per unit. Okay, so remember we calculated selling price per unit here when we said 2,3,500 divided by 235. Okay, so it's our selling price per unit, and we are multiplying that by the level of units. So we've got the 235 per month. So it's actually, there hasn't really been a change. So it actually is 0 if you actually are going to calculate it, because there hasn't really been a change. We have 235,000 unit sales level, and we know that the unit price we have. So you can actually factor in that your percentage sales is 0. Change in sales actually 0. Okay, which means that a total degree of leverage, we wouldn't really have an answer, or it would be not at this stage because there has been no change in our sales. Okay, and how do I know that? I can see that my total selling price divided by that gives me a value, and my unit sales has not changed. Oh, wait, it has. Okay, it's once per annum and once per month. So let me just fix that. I'm going to say 300. Okay, that's my sales units times the 235 times 12. I'm going to say minus the same selling price per unit. Okay, so what does that look like? Let's just calculate that quickly. It would be divided by, and I mustn't forget to also include the division. Because remember, I want the percentage sales, so I mustn't forget that. Then gives us the 25 million divided by the and then we have our answer of 1669%, which I had earlier put in the wrong section. All right, and that is this question answered. Okay. Any questions at this point? All right, so this is all we have time for. So I did say earlier that there were two past paper questions that we needed to go through. One was for Learning Unit 1, one for Learning Unit 2. We only managed to do Learning Unit 2's question. I will just make sure that both papers and their solutions are made available. The slides are made available, the whiteboard is made available, the Excel sheets, everything, as well as a formula sheet, so you can see what formulas are going to be included. And not all of them are included. Again, quite a few formulas in Learning Unit 1, not so much in Learning Unit 2. Okay, any questions?
How do we pass?
How do you pass, Scotty? Yeah,
Yes.
you've just got to, so you obviously got to know the formulas, and you've got to be able to identify the different pieces that are being asked. What I mean by that is if they're asking for the cost of capital, what are the different costs that they're asking you to do? And obviously practice questions. So definitely the questions in the textbook are pretty good, and then any past paper questions are also pretty good as well.
All right. Thanks.
Anyone else? So in terms of the theory questions, yes, there are a few. So like, what are the assumptions for cost of capital? That's quite important. In your leveraging, there's quite a lot. Like, what are the different types of leverage, which you obviously have a formula for, but you've also got your the capital structure graph that we didn't go through. We wouldn't have time for today, but the capital structure graph, you need to be able to interpret that. So there's a bit of, I wouldn't say theory, but understanding there. But the main theory, then obviously you have your other considerations in capital structure. So that's page 66 and 67. Yeah, so those are the main ones. So it's the graph, the information relating to the graphs, or the graph in unit 2, your other considerations in capital structure decision making, and then the assumptions relating to cost of capital. Those are probably the most important theoretical pieces. Yeah, in terms of learning unit 1 and 2. Any other questions? Yes, the recording will be on YouTube. So I'm just also responding to this. Probably only tomorrow, but it will definitely be there. And then the ranking of your capital structure, yes, you do need to understand that because there could be something that comes out of there. But yes, please know that. Okay. Yep, you have to know Miller and Modigliani. So you need to be able to understand the graph. So you need to be able to understand the graph. So if they give you a graph, can you interpret it? What does it mean? But it's, the most important one is the one on page 58, which is the optimal capital structure range, because that's the combination of all the different graphs together. Yeah. Okay. So secured and unsecured debt. Secured is basically when you've put an asset against it to say that if I default, you can take my asset away. Unsecured debt, there's no asset pegged against it. So that's the main difference. Okay. No worries. So you need to know all the different capital structures. You must know how to explain them. Yes, you must know that. I mean, that's inherent. Okay, any other questions? I'm seeing there's a few. No, so I'm not I don't get this answer, Mark. But we can chat about it offline. So maybe when I share the solution, that might help you. No, the answer is the same. Either way, either if you do it whichever year. So maybe we can just unpack that separately. Okay. Okay, I think that's it, everybody. Thank you so much. I will just pop my I will just make sure that I give you everything, or you will get everything. So, and I'll share it with the lecturers as well. And there is about a week, so you've got time. So if you don't get anything by close of business tomorrow, please just reach out. All right. Thanks, everybody.